Hi, welcome to Main Street Macro. I'm Neela Richardson. Making it look easy. That's what the great ones always do, don't they? They make it look easy. Whether it's Meryl Streep or Michael Jordan, no matter how hard, no matter what the feat, everything comes off seamless. Well, that's exactly what the Fed tried to do last week when they committed to raising short-term interest rates by a half a percentage point. What they're trying to do is actually really hard. They're trying to rein in inflation without choking off growth. But they're going to make it look easy. And for now, Wall Street is really satisfied about the Fed's game plan. Main Street, though, might be taking a wait-and-see approach to see if it actually works. Here are 3 things to keep in mind as the Fed tries to pull off one of the trickiest maneuvers in modern monetary history. Well, 1, it's complicated. The Fed has a 3-step game plan to lower inflation. The first is to raise short-term interest rates, which we discussed. The second, though, is also to shrink the balance sheet. As we've talked about before, the Fed has been buying a lot of bonds, and that's stimulated the economy. Now they have to pull back on that bond buying, and that is pretty tricky. And then the third thing the Fed has to do is keep an eye on the jobs recovery, particularly wages. From the Fed's perspective, they don't want wages to keep going up and up and up, even though I kind of do, as long as it's for the right reasons. If wages are actually feeding inflation, it's not good for anybody, not for workers or for companies. And so the Fed has to be very careful with that. The second thing to keep in mind is what's at stake. Well, the first thing is recession. You see, whenever the Fed starts raising interest rates, there's always a specter of recession. In fact, that's usually what happens in terms of an economic cycle. The economy overheats, and then the Fed starts raising interest rates in order to pull down inflation, triggering a recession. They want to trim down an overheated economy. Except the economy wasn't overheating last quarter. GDP actually fell 1.4%. And that leads to a second concern, stagflation. That's where the economy slows down, but inflation still remains high. Finally, the third thing to keep in mind is what to expect. Number 1 is some short-term pain. Markets have already been a bit jittery on the specter of higher interest rates. And you should be aware that you could expect some continued stock fluctuations and market volatility like we saw in April. But Wall Street is not the whole economy. In fact, it's just a sliver of the economy. Main Street is the bulk of the economy. And Main Street could slow down from inflation, from prices going up too much, rather than from slightly higher interest rates. You should also expect some long-term gain. Fed policy is not like a slam dunk. It's not even like a layup. You have to wait a long time to see if you scored a goal in terms of inflation, like 6 to 9 months. We're likely to see substantial lowering later this year, but it could still be higher in terms of inflation than what Main Street is used to. If you have to choose higher rates or lower inflation is definitely the way to go. It's just the path to get there may take some expert moves. Thanks for watching the Main Street Macro. For more information on wages, on inflation, and that all-important jobs report last week, please go to adpri.org.